Kenya's central bank unexpectedly raised its key interest rate for the first time in almost 7 years. The Monetary Policy Committee increased the rate by 50 basis points to 7.5%, first increase since July 2015. None of 5 economists in a Bloomberg survey predicted the move. Inflation has quickened to 6.5% in April, edging closer to the central bank's 2.5% to 7.5% target band. To discuss further, we're joined from Nairobi by Kelvin Ngigie, who is an Equities and Fixed Income Analyst with Ghenghis Investment Bank. Kevin, good afternoon to you. Thank you so much for joining us. Good to see you again. So like almost everyone else, I guess, was this rate hike prompted by rising inflation?
Thank you very much for having me, Rogers. Indeed, it is a pleasure. And yes, so many analysts' consensus is that inflation was out of range. Yeah, well, it is within the 7.5 CBK's target, but the real inflation on the ground was really taking off. So it is an assumption that this rate hike was indeed brought forward by the rising inflation. But the reality on the ground is that despite the hike to 7.5, we don't expect the CBK to achieve its mandate of price stability, since one of the reasons we're having this high inflation is what we call the imported inflation.
Thank you. Now, once language has been expressed that bringing down inflation is the target, it was here in Nigeria, in Ghana, Kenya, everywhere else, do you possibly get trapped in a continuous cycle where you continue to hike as you chase inflation if it keeps accelerating?
It would be difficult for the CBK here in Kenya to do that. One, remember, we're just 2 months shy to an election. I don't expect politicians to be very comfortable with these rate hikes, especially now that they're going to talk to the masses in a bid to be re-elected. So we're going to face some headwinds there. Secondly, is that despite a rate hike to 7.5, I don't remember, it's been around 7 years since June 2015, since CBK did a hike. So I don't expect them to, and we just moved by 50 basis points at one go. So I don't expect to see another rate hike, one in the wake to the election, and two, in that most of as I mentioned earlier, most of these inflation that we are seeing in the market right now, remember, is mostly coming from commodity prices and the global crude oil prices. So it's what we call the exogenous factors, or in a better term, imported inflation. So, mopping up liquidity or tightening at this particular point, of course, is going to have a negative effect, especially on the household's earning power, and it becomes worse the lower down the household ladder you go.
And I'm glad you mentioned the elections just 2 months away in August. Any risk of backlash by increasing borrowing costs now with this 50 basis point move?
Well, definitely it's going to, we have a regulation that hasn't been approved by the central bank for banks to charge a risk-based pricing model. Only one bank, Equity Bank, has been approved out of the almost 32 banks. So we don't foresee most banks really adjusting heavily based on the risk-based pricing model, since that hasn't been approved by the regulator, CBK. Though then again, you'll notice that most of the banks in the country charge the CBR plus a band, which is usually around 4.5 to 5% on their loans. So of course, you're going to see an immediate increment in the borrowing cost. That is going to deter most borrowers from, of course, accessing loans. Mortgages are going to be hit. That's the real estate, transport, communication, trade, of course, are going to face the brunt of this. We already had a credit crunch in the country with inflation, as I mentioned to you. On the ground, the inflation, if you look at, say, CPI, a third of the CPI is food costs. Food costs this year alone have jumped up by 12.5%, and we've not even mentioned energy. So I think it's going to be tight. Most consumers are going to employ, of course, tightening their spending attitude. It's going to change the consumer culture, and it's going to hit an already so to speak, households' earnings. So one, I don't foresee any other increment, and two, things are, of course, definitely going to be tougher for consumers in the country.
All right. Well, you mentioned food. You mentioned energy. I want to ask you about foreign exchange. Here's a quote from Razia Khan, who's the head of research for Africa and the Middle East at Standard Chartered Bank. She said, given the pressures on both Forex and inflation, raising the policy rate was the right thing to do, sends the right message on the prioritization of price stability. You've already said that you're not sure if the Central Bank of Kenya can get that mandate of price stability. But what about Forex, the Forex situation? Let's talk about that.
I mean, Raz is right. And yes, theoretically, as an economist, theoretically, raising the rates is the intended effect is, of course, to contain the inflation or anchor it to an expected level. We've seen that with the Fed. But remember, the Fed has the autonomous power of printing money. The CBK doesn't have that luxury. So raising the interest rates, as CBK has done, of course, we're going to see a cost push inflation where final products are going to be more expensive for households. So yes, they could. CBK in itself have many mechanisms on how to contain inflation. You know, they have the interbank rate, they have the 90-day T-bills, of course, they have the CBR. There are so many mechanisms. I don't understand why they specifically chose to employ and to hike the CBR. Looking at past experience, it hasn't really had that effect that the CBK intended. But yes, Razi is right. Hopefully, we get the intended consequences of price stability. But remember, having most of inflation being imported inflation, I don't expect a rate hike locally in the country to contain that. It's not that we have an excess of liquidity chasing after a few goods. It's actually the reverse. We already have a cash crunch, and the expected global macro is not, no one is anticipating it to at least cool off in the next quarter or two. So that's why I'm skeptical about CBK's intention to contain prices by doing a rate hike.
All right, well, it's going to be very interesting to see how things work out if prices continue to rise in the CPI basket. Very quickly, Kenya's Parliamentary Budget Office has a forecast of GDP growth for 2022 at 4.9%, 7.5% last year. What do you make of their projection for this year?
I mean, they're thinking the same way I'm thinking in terms of course, it's going to be tighter, and they came up with these estimates. I think some minutes or hours shy to CBK coming up with a rate hike. So, of course, even the 4.9 might not be achievable in the wake of a credit crunch in the country. Of course, we have elections. Most enterprises and households are keeping a close eye on their spending. So everyone is just, with the expectation that, this is a two-horse race and no one knows who really could take it. And of course, as the culture in Kenya is, the winner could, cry foul and say, the election was still announced, that's happening. At worst, we could go back to, some sort of post-election violence. I don't anticipate it, but it's a possibility. So with that in mind, investors, both foreign and local, of course, are going to really keep a tight hold of their spending culture. So the 4.9 at best, but it's really unrealistic. We could maybe slow down to 4.5 or 4.3.
All right, very, very interesting, fascinating economic metrics coming out of Kenya, and we're glad we had you to talk about them. Kelvin Ngigie, Equities and Fixed Income Analyst at Ghenghis Investment Bank, joining us live from Nairobi. Thank you so much for your thoughts. We appreciate that.